So this is, I think, something that's worth a conversation. Of course, we've seen the news. Trump's off to an amazing start. His first week after being inaugurated last Monday, he's out of the gate, guns blazing, doing a lot of the things that he said he would. But we know from the Fed speaking at the end of December, when they cut by 25 basis points, they had actually taken off a number of the expected rate cuts that were on the dot plot from 2024. So there were going to be, I think, up to 8 rate cuts in 2025, and they cut that down to only 4. The tone that Powell had at the end of December more or less was, we remain dependent on data. They're looking really at 2 things, inflation and unemployment. Right now, both of those things are, unemployment relatively low, inflation, of course, lower than where it was a couple of years ago, but they both are kind of looking precarious and beginning to tick up, which of course means if unemployment's ticking up, it's in a recessionary sign. If inflation's ticking up, obviously that means that they don't have a handle on inflation. And so they're really kind of in this tough spot where they want to remain independent, relied upon data. I actually think they're between a kind of a rock and a hard place. But Trump has come out, it was sometime last week, saying he wants lower rates, he expects lower rates, and I think, to paraphrase, he more or less said yes. He's expecting that Powell's just going to listen to him and kind of give him what he wants. Now, of course, we want lower rates to spur the economy, get job growth going. And I think we're going to see a lot of that just from some of Trump's policies anyway. But if we cut rates to kind of boost the economy, we're also going to lose control of inflation. And so Powell's very hesitant to do that. But Powell also stated just in the fall that he knows that we have had a very tight monetary policy and we have had rates too high for too long. And so he also doesn't want to hold for too long because we could see unemployment beginning to tick back up again. So there's this challenge where he is not going to want to, what's the word I'm looking for, more or less kind of bow to Trump right out of the gates. He's going to want to kind of maintain his credibility and his independence, but he's also not going to want to get into a big fight with Trump right out of the gate where, Trump could call for his resignation or something like that. But again, I'll note from last week, Powell was asked directly by a Washington Post journalist, would you leave if asked by Trump? And he flat out said, absolutely not.
Right.
And there's no legal basis for that. So I think markets probably need lower rates to continue this upward trend. Without them, we'll likely see some form of correction. But again, with rate cuts, might be good for the stock market for the short to medium term, but then we've got inflation ticking back up and hurting consumers. So
100%.
it's a really sticky spot to be in, and I don't envy Powell at all.
Yeah, no, and I think that's what I've been saying a lot when people are talking to me. It's Trump's strategy is high growth, high inflation. There's no middle ground to what he's trying to accomplish.
Right.
And this is very much what a business person would do. They would spend money to make money, right? That they're not going to sit around and wait for things to happen. They're going to be aggressive and try to grow, the economy, grow the GDP. These are the things that they want to do. But yeah, I mean, all roads lead to inflation, I think, as Paul Tudor Jones said in November of last year. And so that there's just kind of no way around it. Even if they don't lower rates, I still think inflation is going to be sticky for this whole year, even if they do nothing.
I agree.
I have a hard time believing that they're going to be able to do absolutely nothing. So it is a very difficult position.
It is
to be in right now.
So this next slide just shows you quickly what the market's pricing in for tomorrow's cut. So typically the market's generally correct. So we've got a 97.9% probability of Powell simply marking or holding rates at the current funds rate. But the tone, again, and probably now more than at any time in history does the tone from the Fed chair actually dictate, the sort of immediate direction of markets. So if he were to come out and be extremely hawkish, which means tough on keeping rates where they're at, saying that we want to really ward off any return in inflation. If he says kind of along the lines of we're keeping rates where they're at until further notice, and we're worried about inflation still, so we're not committing to any cuts, in the shorter term. We're just going to see how it goes. I think that'll be all you need to spook an already spooked market.
Yeah, 100%.
And we could see a continuation of this kind of waterfall effect in tech stocks and then in the major indices as well. Yeah. But then, of course, Trump's response to that will be very, very interesting to note, and we'll see how things play out from there. So this is a great place to go next. So on bond yields and the 10-year U.S. Treasury note. So we know from the middle of September when they began to cut, that's when they did the big 50 basis point rate cut. We all thought that mortgages would come down, any form of debt would come down. But what happens is when the Fed adjusts the Fed funds rate, they really only impact kind of shorter term debt. The 10-year, we know, essentially controls the majority of debt markets. And what we know from what happened in 2020 and in 2021, Colin, is when you lower rates dramatically, it leads to inflation. So we have this kind of not recency bias, but markets, especially the bond markets, basically not forgotten the lesson of the last few years, which is if we're lowering rates, we're going to bring back inflation. And so if we look at the chart on the next slide, this just shows us the yield on the 10-year. And when you see that kind of middle of it there, where it was fairly low come middle of September, the 10-year yield had actually been dropping pretty much all year. But that 50 basis point that's marked by the letter C there, that actually kind of marked the jump in yields and the pricing in of inflation down the road. And so the bond market, and what's been referred to, this is a term kind of in the 80s, bond market vigilantes. It's like the bond market is controlled by investors and capital flows. So if people are selling bonds, they don't want to hold them, you're going to have yields spike. And if people are buying bonds and the price of bonds is going up, you're going to have yields come down. Well, people don't want to own bonds long term if we're cutting rates again because it's inflationary. And so the few bondholders that we have now that are left demand a higher yield. And what I think could happen, at least in the shorter term, is it has corrected just for the beginning of the year in 2025. But I think we're probably ready to take out that high from the end of December. And we could get back into the 5% range. We could see something like that.
And wouldn't you say that the bond market, in essence, is saying the return's not enough, right? I mean, that's really what they're saying. They're saying that we need to make more on this to lock in our money. We need to make substantially higher than this 4.6, 4.7%.
Yeah.
And the last time that happened that we had rates even this high was 2008, right? I mean, 2008 was the last time we saw rates on the 10-year near these numbers. So they're saying inflation's going to be higher. I'm going to be able to get bonds at a higher rate, which means that, the market's got a lot of room, that the bond market's going to continue, and there's going to be more selling. They're going to continue to be selling bonds because they anticipate they're going to be able to buy these 10 years in the 5 and the 5 1/4, and who knows, where things go.
That's right. And in the meantime, we've got, debt markets across the board that are pretty much dying for lower rates, but aren't getting them despite these cuts from the Fed. So I saw an interesting stat yesterday, said 71% of realtors in the United States had no closed deals in 2024. We know this is impacting the real estate market. Prices haven't necessarily started to come down, but of course you're seeing it kind of on the front end with lack of sales and historic low sales volume. On the other hand, you've got a ton of corporate debt that was taken out in 2020 and 2021 at these really, really low rates that are now kind of coming into a big renewal wall in 2025 and in 2026, because some of these corporate debt instruments are 5-year kind of rollover. So a lot of corporate debt's going to be rolled over at rates that are 3-4 times higher than they were
Yeah.
when they took on all this debt during COVID.
Yeah,
So
I've been talking a lot about the debt, the commercial debt, and really the strategy with banks right now is extend and pretend. That's really the strategy that works. That basically they have loans coming due this year. Commercial mortgages are anywhere from 3, 5, or 10-year terms. People may not be aware. So office buildings, apartments, retail, they don't get 30-year mortgages like homeowners do. So
right,
they're
exactly.
coming due. Billions of dollars are coming due, and these properties rents are down or flat. Vacancy is up, and the bank has to underwrite the deal to what it is today, plus adding in what the rates are. And so a lot of these, and I can tell you, I know so I own, apartment buildings. I have debt at 3.25, 3.75%, 4%. If you rewrite that debt today, it's going to be in the high fives, low sixes. So the bank, instead of rewriting the debt, it maybe extends at some middle ground for a year, and then they're going to see what happens in a year. Otherwise, the other option is that they'll end up rewriting at this much higher rate, and then the borrower can't afford that higher payment,
Right.
and then they'll foreclose on the property, which is the worst thing that could happen. We all know what happened in 2008, 2009, is that the government had to come in and bail out the banks. And so the goal today is to avoid that situation, because in essence, the taxpayer ends up just paying for it, right? When we bail out the banks, it's just another form of inflation to the taxpayer.
Yeah.
And so that's what they're trying to avoid. And that's why this whole thing about rates is so important.
Very.
You have so many jobs. You have 71% of realtors that made no money last year.
Yep.
You have all that tax income that's not coming in that we need as a government right now. We have all that income for that individual that didn't make any money.
Yep.
So there's just so many layers to this, that the commercial debt bubble, I mean, it's just
Agreed.
a massive bubble. And then, Trump has mentioned that they want to sell a lot of their office space. So now you're adding more office space
More
to the market.
Exactly. More inventory,
which is going to drive the price down
even further.
And it'll create a lot of great opportunities for, people that have wealth, that have assets available. But it's also putting people through a lot of pain. And that's why, you and I always talk about diversification.
Yeah.
Because if you have all your eggs in the real estate basket right now, you're in a lot of pain. It's tough.
Another interesting and related point is, we know that there were a few banks that went bust in the spring of 2023, Colin, and that was madness here for us, right? That was out of the blue, panic buying, everyone wanting their money out of the bank because they didn't know which one comes next. I think the banks are more vulnerable than people want to believe. And it's because a lot of hold to maturity assets like bonds or commercial real estate mortgages, they don't actually have to really disclose the losses that are being incurred because they're longer dated assets. They don't have to have that kind of that live portfolio loss calculation. But it could just happen all of a sudden again at some point that another bank goes down. Maybe it's not smaller regional banks this time. And so gold and silver physically get you out of the dollar, get you out of the bank, and they're out of the market in the sense that you're in a negatively correlated asset most of the time. When the stock market goes down, the metals go ballistic. So getting some of your money out of the bank and into a format that can't be taken from you, has no counterparty risk. It's yours. It's physical. It's there. And again, you have no currency exposure. The banking fragility or banking system fragility, I think, is kind of an understated risk.
Yeah, there's going to be a lot of banks that go out of business this year. There's no doubt about it. In 2023, that was a bond, collapse with a lot of those banks because they bought bonds at the wrong time. Now it's going to be a debt bubble. They're going to run out of ways to cover, and they're going to have a lot of loans come back, and they're going to have a lot of people stop paying. And it's a very difficult situation for those banks that, not that I feel bad for banking system, but you do have to have banks available. People need to move money around.
Properly functioning. Absolutely.
Yeah. And so it is quite quite desperate times. I think people, I say it a lot. They look at these rates the banks are offering, these 4.25%, and just because they're offering 2 or 300 basis points more than they were offering a few years ago, it's just because inflation is so much higher that they're able to offer these 4% returns in the bank, and they feel like they're better. People get excited about it, but then when you look at the cost of goods going up 15-20%, or the cost of energy going up,
Yeah.
the cost of everything going up, food costs going up 15-20-30%, the 4% sort of feels like you're getting stiffed a little bit.
It's a negative real return, right? So you just
Yeah.
can't protect your money enough, and even in a long-term bond with yields of 5%, it's just not enough to actually hedge from inflation, right?
Yeah.
So I think the bond market, to come back to it and maybe kind of just summarize, is we will probably see yields continue to kind of rise higher. Now it might not be
Really, where do
a
we
big
go?
a big steep move, but I do think that until a time when the stock market crashes and there's a lot of buying for bonds. And if there's a lot of buying for bonds, the yields should come down. So in a stock market crash, I think 10-year yields could come down. But until that time, I think they go up.